I'd say lazy duffs and getting back to work. We had a holiday Thursday and some of us took a holiday Friday, but we're back in it. It seems like a little bit of light volume today.
Light, depending where you're looking. I think the theme now has shifted away from US elections for now. I think a lot of that is obviously priced, and we're actually focusing quite a bit on Europe for a change. There's quite a
Yep.
bit of volatility out in Europe, given what's happening in France in particular. That, as well as we've now got a chorus of, ECB central bankers talking about, 50 basis points being a live option for December meeting. So I think the volatility has shifted and the focus is shifting into Europe for now. Of course, we'll do something in Europe and then, at some point we'll revert back to the US. But yeah, there's definitely a bit of movement in Europe at the moment.
And in France, it's all about the budget, right? It's about passing a budget, and it's funny because we just kicked the can down the road. We can't get everything in a row, so we just pass an amendment and raise the debt ceiling. But that's a little more serious in Europe.
It is and it isn't. It used to be when I first
Mhm.
started trading. There was an ironclad agreement in Europe that we would always stick to the agreement of holding debt to GDP at a certain level.
Mhm.
It's effectively within the constitution of what makes up the EU. But what we've noticed since COVID is, of course, everyone relaxed the rules. We're now 4 years, beyond COVID, and many countries are still not back to where they were pre-COVID. I mean, the likes of France are spending 6.5% debt to GDP per year, so no different to the US. The only difference is I suspect the money that's spent in the US is a lot more coordinated and directed. In Europe, we just subsidize things in a very
Right.
bad way. So I think what you're seeing now is a real shift in Europe as to firstly this sort of it used to be that no, we do not spend beyond our means. Now it's a case of well, if you don't spend beyond your means, you're going to fall behind. And we're seeing, of course, France is now in a bit of a pickle, and we have Germany. I mean, they're at a governmental level, they've got an election coming up. So the issue is that people are just fed up with no spending in Europe, and I suspect next year is going to be more about Europe spending as opposed to this sort of sticking to a debt to GDP ratio. So no, I think Europe's going very much exactly the same way as the US. So I think it's one to watch as a key theme for next year.
That's interesting. So today, I think we're going to talk about a little bit about which index future to trade, right? We're going to look at some of the differences and how you might determine which one to would trade. It seems pretty straightforward, but I'm looking at a chart you have up here. I love this chart.
Yeah, I think I think just having a look at the chart, I'm wondering if that's the right chart there. Um, can you see the four different indices there?
Yes,
Yeah.
exactly.
Yeah. So I
Yeah.
think the first thing to say is, which index to trade. That's kind of how I've looked at this. And, traditionally over the last, let's say, almost 10 years, you wouldn't look anywhere but US indices as a trader because what's the point? Nothing else really moves. Now, I mentioned to you previously that, Europe now might open the fiscal taps next year. And if that's the case, well, I suspect you'll see a lot of money flowing away from US indices back towards Europe because Europe historically is cheap relative to the US and for good reason. Why would you invest your money in Europe? So let's now focus on the US because that's the topic of today's discussion. Which index should you trade as a trader? And it depends. There's an expression you must learn and almost marry is that you always want to be buying the outperformers and selling the underperformers. Okay. And what
Mhm.
that means is that these all indices, they're all correlated to some degree. And so when markets are rallying, when we have a risk on sentiment, they're all going to rally. But you don't want to buy the weak ones. Okay, you want to buy the strong one because that's the one that's going to give you the outperformance. That's one that's you're not going to go very far inside. That's the one you can deploy leverage. And so that's this concept of buying the outperformers and selling. Sorry, buying the outperformers and selling the underperformers. Okay, always trade strength to the upside and sell weakness to the downside. Now, in terms of the different sort of indices, what I've got here for you, it's again, this idea of a rebasing index to showcase to you that, in the real light blue, we've got the FANGs, okay, and that's the FANG index, and we can talk about what makes up this index. And if you compare that to sort of the more dark blue over here, that's the Russell. Now you can see at a performance level since 2020, fine, Russell's up 80%, but FANGs are up 450%. Why?
Right.
Well, because the last 4 years has been all about this idea of FANGs and AI, and it's been all about technology stocks. Sorry, the Mag 7 and AI. So it's important to stress that when these themes exist, when these fundamental drivers are there, trade the FANG index, trade the NASDAQ. Don't worry about the Russell. Okay, yes, the Russell will go bid and will go off, but that's not where the opportunity scope is. And so that's the first theme to sort of bring to your attention, Tom, is that there is a time and a place to trade different indices. You don't want to just say, well, I'm a Russell trader, I trade Russell. No,
Right.
trade the theme that's ultimately driving, the biggest bang for buck. That's the way to look at it.
Yeah, I like this. In the futures, in markets, we have those futures on these indices, and given that I don't think we have one for the FANGs outright, you might substitute Nasdaq, and I know you have Nasdaq up here. In lieu of that fact, Nasdaq would be the one you would probably want to go along with if you're investing in the outperformers. Um, but you're right. It's the reason why I love this chart is it's a basically a percent change chart essentially. I mean, not quite. Is it a index
Yep.
chart or is it a percent change?
No, this is just a percentage change.
It
So if
it is a
we sort of
percentage
call them all
change. So
apples, yeah, exactly, exactly. And I think the key takeaway, and this is kind of how you want to think about the indices in general. And you're right, we don't yet have a FANG index in terms of the futures. CME will pretty much be bringing that on at some point in time. There just needs to be sufficient demand for it. But what you want to take away from it, and I'll kind of just highlight this, if you go to the start of Q3, and probably the wrong color pen to use, if you go to the start of 2023. Look at that rally in the FANGs. We 150% rally in a space of 3 quarters. At the
right.
same time, what's the Russell done? Nothing. Okay, what's the Nasdaq done? Well, the Nasdaq showcased, and as you said, yeah, trade the Nasdaq off of that. What's the S&P done? Sure, it's up 15%, but that's as traders not where we want to be playing. We want to be playing where the opportunity scope is. So that's why we look at it this way, is we want to make sure when there is a theme, we're trading the appropriate markets based on the theme. And I'll show you another chart a little bit later on where we look at this year. What has the themes been this year? So you can start to understand what are the drivers you as a trader should focus on, and what are markets sensitive to those drivers. That you're always trading, like I said, you want to buy the outperformance, sell the underperformance. That's a way to look at it. So I think for your users, I mean, I'm not going to spend too much time on this because it's more theory. You can go read up about it. But the way to think about the indices and the way I always think about it, the most volatile. And when I say volatile, think in terms of what's the most sensitive to a theme. It's always going to be the FANG. Why? Because it's made up of 10 stocks. Okay. And yes, it's an equal weighted index, which does reduce the volatility somewhat. But in general, when the Mag 7 is doing well, when the world is very positive on technology stocks, okay, nothing beats trading the FANG index. You've got to be trading it. Now, second to that, and also second in terms of volatility, is always going to be the NASDAQ, okay? Because NASDAQ is pretty much 65% technology. So it's basically the FANG plus consumer discretionary, okay? Between consumer discretionary and FANGs, they make up about 80% of the NASDAQ. So by and large, the NASDAQ is just FANG plus a bit of consumer discretionary, right? And that's why there is that direct correlation between the two. In terms of the next best to trade, it's very much the S&P. Why? Well, because the S&P again does have a lot of the Nasdaq and it does have a lot of the technology stocks in, but it's more broad-based. It's 500 companies. It's not as volatile, of course, as the Nasdaq because it's a blend of many different types of companies. Okay, so the S&P is kind of seen as the bellwether. That's the one that tracks both technology as well as the general economy very, very well. Okay. And then, of course, you got Russell, which is small companies, small stocks, and the Dow Jones. And in that order, I would say you would have the most volatile or the most potential to move based on new themes versus the least likely to move, which is the Dow Jones. Okay. Dow Jones, very much price weighted, just big companies. They don't really show much volatility. Of course, there are times where they're volatile, but a lot less because they are blue chip names. So that's a way to think about the indices. Now, to narrow that down even to a more simpler sort of understanding what we go through in terms of when we teach a trader to understand the drivers of indices is macro factors. Okay, what are the key drivers? Now, again, I'm not going to spend time on this because this goes very in depth and this is a topic for a couple of hours, but there are key things that drive stocks, and I want to bring your attention to 3 of them because I'll show you this on a chart. That's interest rates and economic growth and corporate earnings. Okay. between those three big macro drivers, ultimately the indices will move up and down. Okay, and we'll talk about that very briefly. But again, the users can ultimately just take a snapshot of that because this is the playbook for trading indices. Okay, it doesn't matter what the index is. They're of course they're more or less sensitive to these macro indices or these macro factors, but that gives you a snapshot of what are the drivers from a macro standpoint of indices in general. Okay, Tom, I'm going to pause here before I move on because I know I'm kind of just moving around, but I just want to bring the story across. So is there anything in terms of those macro factors, or you want me just to go on with the next chart?
No, I thought it was, I think that is a great, that's probably the most comprehensive and succinct description of, macro factors, what we should look out for, because it's easy to get lost in the stories. How do we interpret this? What markets are we looking at? And I think that last slide was really great in terms of, the most pertinent factors that could move markets depending on which market you're looking at.
Yeah, and I think one of the key things is it's never, and I think we mentioned this in one of our previous discussions when we spoke about the playbook for gold. The reality is it's never one individual thing. Okay, you'll so often see on social media or when you read, the Wall Street Journal, you'll see they'll say, Fed expectations of interest rates are rising and therefore equities are selling. It's not
Yeah.
that straightforward. I wish it was.
Right.
Unfortunately, journalists are not financial analysts. They don't really understand that yes, interest rates is one piece of the puzzle. There's
Mhm.
inflation, there's GDP, and it's all about if the Fed does move interest rates higher, what are the implications for inflation? Okay, now in some instances, you would think higher interest rates should be less demand, should be less inflation. But if interest rates aren't high enough, then it won't destroy demand. So there
Right.
is nuance involved, and that's why you've always got to be careful reading newspapers because they are a little bit misleading, and it's about always assessing them, these macro factors that I showed you, assessing them all together. Okay, and we'll talk a little bit about. In fact, if we bring up the next slide, let's talk about it so you get an understanding of that.
Sure.
What you've got there in the orange is you've got 2-year yields. Okay, so think about that as interest rates. This is the expectations of interest rates, what markets think interest rates will be, starting 2 years from now. Now, in the purple, we've got the NASDAQ. Now, why I've put NASDAQ is because if you go back to that discussion of what are the most sensitive and least sensitive, well, NASDAQ is going to be the most sensitive to interest rate changes or expectations of where interest rates are going. It's going to be very, very sensitive to it. Okay. Now, the key that we do is, we go and look back at history. So we obviously, of course, look all the way back to 1999, and we can see that in that cutting cycle that we saw, heading into the year 2000, of course, we had .com, et cetera, et cetera. We had that significant rally, and then, of course, we had the great collapse of everything. Interest rates collapsed, and we can see that NASDAQ gave up all that, sort of returns that it had in that 99 .com bubble. Now, the point is that technology stocks are very, very sensitive to high interest rates, not interest rates going up. Okay, so that's very key
Mhm.
to stress is that typically what happens is when we get an interest rate cycle, okay, yes, you can see that over that period from 2004 to 2008, the NASDAQ returned 26, 27% over 3, 4 years. Okay, that's insignificant for a volatile index that's naturally volatile. That's a really poor underperformance. And if you go compare some of the other indices there, you'll see they perhaps perform better. Why
Right.
did the NASDAQ underperform then? Well, because interest rates were moving higher. Now, were those interest rates so high that they created a problem for the NASDAQ? Well, obviously not. Otherwise, we wouldn't have had positive returns. Okay, and that's that key. It's that, yes, higher interest rates are problematic for technology stocks, but only if they lead to a destruction in growth and demand, i.e. GDP. In other words, if the Fed set interest rates so high to the point that it actually led to some form of a recession, then this NASDAQ would have been negative in terms of its return. Okay. And that's what I mean by it's not just one single macro factor. It's that macro factor. How does that influence demand? How does that influence inflation? How does that influence growth at the end of the day? Okay. Now, in a basic sense, if you want to think about this, and I'll show this to you on another chart, always think of in terms of interest rates in tandem with growth. Okay. Is the
Mhm.
interest rate so high that it destroys growth or leads to negative growth? Yes or no? If it does, i.e., lead to a destruction in demand and growth, we'll get some form of a recession, and equity indices will always underperform in a recession. Okay.
Mhm.
Now, again, this is why I say I have to be cautious with my words here, because if you look in recent past, going back to 2010, we had that recession. Okay, so you can see there's the financial crisis in the NASDAQ sold off. We can see the Fed cut interest rates very aggressively. They begun the process of quantitative easing. And what did we see? Well, we slowly saw, even though this was an average of around 1.4% growth over a period of 4 or 5 years, even though it was very sort of anemic growth relative to the long run average, we can see that that was enough for stocks. Okay, they rallied 580% over the course of the next, 8, 9 years. Okay, so it's always a case of what does policy do ultimately in terms of growth expectations? Okay, if policy is too tight, you'll have lower growth expectations, which is not good for equities. If they're negative growth expectations, that's bad for equities. But if they outperform growth expectations, that's when we get this. Okay, and that leads me to the next chart. I'm going to kind of move a little bit beyond you because you get the idea of what I'm getting at. COVID there, you had, again, we had the recessionary fear. That's that move there. The Fed promised to do whatever it takes. They had the bazooka in terms of QE, and equity said, thank you. We then had a Fed that said, look, we need to hike 50, hike 50, hike 75. And all of a sudden, equity said, whoa, what's going on here? Where's this going to stop? There was fear, there was panic. And eventually we bottomed out because the market realized that, well, look, that's the top for rates. It's not going any higher. Okay.
Mm-hmm.
So it's all about where those interest rates go, how they tug on ultimately growth expectations into the future. That's what drives the stocks. Okay. Now, one more chart and then we'll come back to the indexes. But this is important to understand and stress is that this is now a chart of long-term growth. Okay. So often I see people talking about, oh, we're going to hit a recession. It's overbought. Oh, valuations, blah, 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 blah. The reality is in the green, you've got current 1-year average growth expectations. In the purple, you've got 10-year growth expectations. And you can see prior to the financial crisis, what do growth expectations do? What did that purple line do? Well, it sank from around 2.3% all the way to around 1.1, 1.2%. In other words, even during a period where the Fed was doing unlimited quantitative easing and interest rates were zero bound, we really didn't have any growth coming out of the US. Okay. Now, yes, equities did rally quite extensively at that period. Why? Well, because we had some growth, but we also had this continual promise that we will keep rates at zero. Now, in an environment where you keep rates at zero, there's no risk ultimately to holding equities because if you go and hold bonds, you're going to get negative yield on that. Right? And that's why equities did so well in that era. There just was no alternative to owning equities. Right now, if you see what's happened since COVID era, look what that purple line's done. Okay, we're back at 2.3%. We can see the green line is very much above long-term growth. And when you hear economists talking about the long-term growth expectations, for the US, it's somewhere around 2.2, 2.3%. Okay, so in other words, if we're growing above that, what that's telling us is the US economy is growing a lot better than is expected. And that's why, if you look at that NASDAQ, that's why we are staging this rally. That's why the markets are so upbeat about what comes, particularly next year. Okay, it's all got to do with this idea that the US government spending, if they're spending, we're going to see above average trend growth. And that's only going to be positive for stocks for 2025.
So real quick, Brannigan, in light of that, I think of the new administration coming in. You have Elon Musk heading the Doge Group, right? Department of Government. What is it? I forget what it is, but accountability, basically, right?
Yeah.
We're gonna cut the budget. We're gonna, spending. Well, some people are calling for spending to go down. Does that affect that growth aspect? I know we're talking about government versus private equity, but if we're seeing that rates are maybe stable. We don't have another 25 basis point rate cut baked in the cake for December, I don't think. And, maybe we're going to be cutting the budget. Does that affect growth estimations going forward?
Yeah, I think the first thing to sort of question, and maybe we talk about Powell next week, but I disagree. I think the Fed does cut in December. I think they have to cut in December. We talk about that separately, but let's address the question. If the Doge committee is more effective for every dollar of debt, and they can get better output as a result of every single dollar of debt, the reality is that's only going to ignite a rocket underneath not just the US economy, but in general, stock market. Because then the day, what's going to happen? Again, there's two parts to this. Okay. In a soft landing environment, which is what the consensus expectation is. In a soft landing environment, what happens is the Fed is capable of continuing cutting. In other words, they can cut another 4 times next year as they think they can do via the dot plot. That's what they think. That's what the expectations are. So what you get is a situation where they continue cutting. That provides some stimulus. We've also got the fiscal stimulus side of the equation that keeps driving growth. Now, if you get this third pillar where we actually have that additional sort of, let's call it, efficiency gains, okay, that can be put to better use, that's only going to drive GDP even further up. Okay, so
Right.
under the assumption that we do actually get a soft landing where the Fed can keep cutting rates at the same time we get, fiscal efficiency, I mean, that's massively positive because that GDP side of things should then begin, or should at least stay elevated around 2.6, 2.7%, for the whole of next year. If that's the case, there's nothing really that suggests we shouldn't have double-digit growth again in both, NASDAQ and S&P next year.
Excellent.
So hopefully that answers that question.
Yes.
I think the key sort of other side of the coin, and this is why you always got to have a thesis. The other side of the coin is that the Fed has to stop. Okay, you mentioned the Fed. Your belief is the Fed may have to pause in December, and I get that. I understand that logic. Things are a little bit better than expected. Now, the reason I'm pushing back on that is because the Fed is not cutting to provide stimulus. They're cutting because they don't want, or they don't believe they need to be overly tight right now. Okay, they still believe that they are quite overly tight, and that's why they've used this word recalibration, which is we need to get a little bit closer to neutral. Now, we're still a long way from where neutral is. Okay, so hence why I think December still comes, and then they move to sort of every other meeting type approach. But what I want to stress is what has happened in history. If you go back to 95, it's the only time we've had a soft landing. But what happened back then was they cut twice and then they stopped. And they didn't cut again for a period of 2-3 years. Okay. Now, if we were to get that scenario, as in the Fed cuts in December, they pause in Jan, but then in March, or I think it's Feb or March, they come out and they say, actually, we think we need to pause for another meeting. The market will stage a fright on that, okay? Because what the market's now going to have to reprice is this idea of, well, where is that endpoint for interest rates? Perhaps it's a little bit higher than what we expected. Okay, don't forget,
Right.
the market thinks that neutral rate somewhere, call it 2.5%, but if all of a sudden now they pause at a rate of, say, 3.5%, that's quite a bit of repricing that needs to take place in the risk markets. Okay, so that's the thesis. That's how you have to think about it. Right now, there's nothing that suggests we're not going to get a soft landing. There's nothing that suggests that the Fed is going to pause or even hike next year. Okay, so until we get some significant reacceleration in data, you can't be changing your thesis. You have to stick with this thesis of, growth is doing very, very well. Interest rates are cutting, fiscal is pumping. Now we've got the efficiency committee coming in. It's really, really just, there's nothing really bad for equities currently.
Right.
Now, if we can just quickly just show you this chart. This is this year. Okay, so this is now just doing a rebasing, looking at this year. And you can see very much the themes for this year, which is start of the year, we had higher inflation. Okay, so we had a higher for longer theme. What did equities do in that period? Well, Russell was pretty much flat. We were down 5% at one point. We were up 5%. Okay, but for all intents and purposes, for the Q1, equities were flat. They didn't move. Then all of a sudden, we started to see the weakening of the data. May, June, July, leading up to that really bad unemployment rate number, we started seeing weakening of the data. The real economy, i.e. the Russell, underperformed. What did NASDAQ and S&P do? Outperform. Why? Because we want to own the Mag 7. If they're going to start a cutting cycle anytime soon, own the good stuff, not the weak stuff. Okay?
Sure.
All of a sudden, really bad non-farms print. What happens? Everything sold off. Russell back to flat in the year. NASDAQ, S&P only up 5-6% on the year. This year for equity indices only started when August. What happened then? Powell signaled the pivot. Okay, we had the Powell pivot, the Jackson Hole pivot. They cut 50 in September, and that's where your returns have come from. They've come from a Fed that started a cutting cycle, not just a small cutting cycle, not a regular cutting cycle, but an aggressive cutting cycle. Right? So a large part of the gains this year have come because the Fed has said, look, we're going to start cutting. We need to cut and get to neutral. That's what the current price is reflecting. And that's why I said, if they were to pause in December, uh-oh. Okay, equity indices are baking in a lot of more cuts coming. They're not expecting any kind of a pause in December. So, and therein you can see Russell's not really been a good one to trade fine. Since Trump came in, that is the time and the only time Russell became good to trade. Why? Well, because Trump wants to get rid of a lot of red tape. He wants to really stimulate the economy, create a lot of subsidies. And that's always going to be better for small companies versus the big companies. Okay, so that's kind of the takeaway from it. You've got to pick your poison. But like I said, trade the good stuff. NASDAQ, S&P, yes, there's more than enough to do there. There is times when you want to trade the Russell, but that's not a playbook that's regularly used. Okay, the Russell, for all intents and purposes, is quite a bit of a boring one. S&P, NASDAQ, there's more than enough opportunity scope there.
Brannigan, this was great. This was really informative, and again, these charts. I love these charts. Where can people find you? I know you're all over YouTube and socials, but what's the best place for people to find you?
Yeah, so I'm quite active on Twitter. So if you just go follow at trader_Bran, I post quite regularly there, and I do encourage comments. It's not that I know it all; it's just I've perhaps been doing this a little bit longer than some people. So yeah, feel free to comment, and I do post interesting charts. That's the key. You want some interesting charts, some interesting thoughts. I like to lean on thesis. Okay, my thesis doesn't change every day. Of course, I do have to update it regularly, but so if you want to follow along how I think about markets, you can do that on Twitter. And then of course I do host all the education on YouTube for Tredello Trading. So I think probably twice a month there'll be videos there. And again, it's topics just like this one, indices, psychology, all sorts of different stuff, strategy. So go have a look at the YouTube channel and you'll see what type of content's there.
Awesome. I recommend everybody do that. Look up Brannigan's work because it is really informative and really insightful, especially if you're trading. You made a point about, news focusing on one aspect and they're not seeing the whole picture. So true. And I think, they're in a different business, right? They're trying to grab your 30 seconds of attention. Nope, not as traders. We need to do a little more thoughtful work, and Brand's the place to go to. So thanks again, Brannigan, for coming on.
Appreciate that, Tom. Thank you very much, everyone.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.